Okay, welcome everyone to the next session of the IPRA conference. So we have a very exciting session coming up with three great speakers. Overall, this session is labelled Current Issues in Pensions, and we cover quite a few things. We'll be covering quite a few things in the next hour and a half. So we have three great speakers. Our first is Peiran Jiao from Maastricht University, and he's an Associate Professor of Finance and also Director of the Maastricht University Behavioural Insights Centre. And his research mainly focuses on behavioural and experimental finance and economics. Our second speaker is Tabea Bucher-Koenen from University of Mannheim, and she is a Professor of Financial Markets and also Head of the Research Unit on Pensions and Sustainable Financial Markets. And Tabea's research focuses on household finance, the economics of ageing and demographic change. And our third speaker is Olivia Mitchell, who we are delighted to have speaking with us this afternoon. Olivia is a professor at the Wharton School, Executive Director of the Pension Research Council, has made huge contributions to this area of research and policy over her career, and was recently awarded the 2023 Distinguished Fellow of the American Economic Association. So we are delighted to have you here with us, Olivia. So I will hand over the floor to Peiran, who will give the first presentation. Each presenter has 20 minutes, as in the earlier session this morning, and then there's 30 minutes for general questions and answers.
Thank you so much for the organizers for giving me this opportunity to present our research. I have to say that I'm new to this field of pension, so don't blame me if I make anything wrong. What I'm going to talk about is related to how we can elicit pension beneficiaries' sustainability preferences. I guess I don't have to convince this audience that sustainability is becoming increasingly important in financial markets, in financial decision-making. And larger and larger amounts of assets under management are invested with some sustainability concerns. And how can we do that? And how should we let investors do that? So if it's, let's say, think about this in a mutual fund context, where investors have a choice. They can choose which mutual fund they invest in. Then there's a study that I'm citing here by Hazel and Sussman, 2019. They show that investors' investment into mutual funds are influenced significantly by the fund's sustainability performances. And they use this natural experiment where the Morningstar started to announce sustainability performances of their funds. And after that, funds that are rated highly on the sustainability score, in which, I mean, if you look at Morningstar, they rate according to the 5 globes. 5 globes means that the fund has the best sustainability performance. So funds that have better sustainability scores, they receive larger inflows of funds from investors. And funds have low sustainability scores, they have outflows. So this is apparently probably already showing that mutual fund investors at least care about sustainability. But how about in the pension context? From the EU taxonomy published in 2021, they mentioned that insurance investment advisors will be required to obtain information not only about the client's investment knowledge and experience, ability to bear losses and risk tolerance as part of the suitability assessment, but also other sustainability preferences. And that also includes pension funds. Pension funds should also understand their clients' sustainability preferences. So should participants of pension plans be involved in setting a fund's sustainable investment agenda? And if so, how can we do that, right? So there has been some responses from Dutch pension funds, and different pension funds have been doing different things in order to achieve this requirement that they understand their clients' sustainability preferences. For instance, some of the pension funds in the Netherlands, they are using some surveys to ask their participants do you like sustainability, and do you want us to include some sustainability goals in our investment portfolios? Other funds, for instance, engage in, let's say, focus groups, discussions with some of their clients. And yet, another group of funds, they didn't do anything. I don't know how they will achieve this goal. But there are many potential pitfalls for different methods that are implemented by different pension funds. For instance, there are different behavioral biases that can be involved when people are answering survey questions or people are responding to these focus group discussions. For instance, what I'm listing a couple of possible behavioral biases here, such as desirability bias or selection bias, so on and so forth. This list can go on and on. So in terms of how we can let pension funds achieve this goal of incorporating clients' sustainability preferences, I think we have to make several steps. First, we have to understand what pension participants want, and then we have to aggregate their preferences, and then we have to know how the aggregated sustainability preference can be embedded in some portfolio strategies of the pension funds. I think there are, in the field, at least from academic research papers, there are already some efforts in this direction. For instance, this paper by my co-author Rob Bauer and his other co-authors, Bauer, Ruoff, and Schmitz, 2021. They collaborated with one of the pension funds in the Netherlands, which is called Detailhandel, and they conducted a field experiment. Basically, what they did was that they told their pension participants that our pension fund right now already have 3 sustainable development goals incorporated in our portfolio strategy. You can now vote, do you want to add a 4th one? So I think first that's already good. That's giving people choices. And from what we understand in economic theory, this is revealed preferences. You can reveal people's preferences from their choices. If you let them choose, they can probably choose what they think is best for them. And quite promisingly, that we are seeing that people, at least these participants in the field experiment at Detailhandel, they like to add a 4th development or sustainable development goal. The majority of the people say yes. Either in they have 2 treatments. One is where they can really have an influence on the final decision of the board, and the other group, it's a hypothetical vote. In both groups, they found that the considerable amount of people actually vote to have the 4th SDG. But is that good enough? Is that what people really want? Or do do people really understand what they want? Because the biggest lesson we learn from behavioral economics and its implication for welfare analysis is that people don't understand what they want, right? And there is an example, I don't know if you're familiar with this, but a couple of years ago, CalPERS, the largest public pension scheme in the United States, based in California, a couple of years ago, they decided to divest from sin stocks, tobacco, energy, so on and so forth. And their pension participants really liked that back then. But then a couple of years later, these pension participants at CalPERS, they found that their pension fund completely missed out the energy boom. And they were angry. They protested on the streets. That already can tell us, to what extent people can understand their own preferences, what makes them happy, and especially what makes them happy in the long run, and also how much cost are they ready to bear by pursuing higher sustainability, right? So what I'm going to present in this talk is trying to understand what is sustainability preference. From what I understand, because I have come with a background in economic or microeconomic theory and behavioral theory, from what I understand, sustainability preference is actually a composition of many different preferences and beliefs. But I guess there is probably a dangerous trend also in the academic literature that we tend to say, we want to say, that investors or pension participants or mutual fund investors, all investors, want to invest with social responsibility because they want to contribute to the world. That is what we call social preferences. There are lots of papers in the academic literature saying that socially responsible investment is because people have social preference. They love the world, they love the earth, they love other people. And there's a little bit other research also pointing at related direction. For instance, social identification and signaling. People invest in socially responsible funds because they can signal to others that they are a good person. And there are also other theories, but basically these literature miss something, which is that in order to understand whether people are willing to trade off sustainability with financial performance, we need to have a better understanding of how people form expectations about financial performance. And what do they think is the connection between sustainability and financial performance? And there is some suggestive evidence, for instance, by this Hasmak and Sussman paper, they show that investors expect funds with higher sustainability performance to have better performance in terms of return, but lower risk. So then, if they are going for the sustainable funds, they're not completely going for it because of the social preference. But then the danger in this literature is that we still don't have good understanding of how they form beliefs. So basically what I want to say here is that sustainability preference is a composition of preferences and beliefs, and it's not a good idea to simply ask people, what do you want? Because they don't understand what they want. And also because that they don't understand what are the true benefits and costs of going for greener in their investment. So what I'm going to address in the following of my talk is based on work in progress with my co-author Rob Bauer and our PhD student Bin Dong. And we use a bunch of lab and field experiments to understand, first, how do investors form their beliefs about the financial performance when they have the information that the fund has higher or lower ESG score, so to speak. What I want to show you is that the literature now is not using the correct method to assess this. I don't know whether this is also true in practice in pension funds or mutual funds when they're assessing clients' beliefs. For instance, this paper by Riedel-Schmitz, 2017, when they're assessing whether people are willing to trade off sustainability with financial performance, they simply ask people to indicate whether they, on this Likert scale, their feeling about this statement, that I expect the returns of socially responsible equity funds compared with conventional equity funds are much lower, a bit lower, the same, a bit higher, or much higher. Do you think this will tell you exactly how well people believe that the ESG funds will perform? Probably not. Why? Because there are potential behavior biases again. For instance, if the person already invested in ESG, then potentially they will tell you, yes, the ESG funds will perform better because they have this desirability bias. Otherwise, I wouldn't invest in this fund, and self-justification bias, because I invest in this fund, I expect it to perform better. That justifies my self-image. But on the other hand, they have this also the image concern. If they think that, oh, I'm going to tell you that I think the financial performance or return of high ESG fund will be worse, because I don't want other people to think that I'm investing in high ESG only because of the money, but because I'm a good person, right? So what do? We try to use a better method to understand people's expectations about financial performances of funds with and without high ESG. And we get a quantitative and incentivized measure of belief about returns with ESG scores. And of course, theoretically, our method is also robust to many different specifications of the utility function, including different risk ambiguity preferences, and different probability weighting, and we also assess people's belief in the short run versus long run, as well as their belief updating given positive versus negative information. So basically, I will quickly tell you what we do. So basically, we give our experimental subjects the past 6-year annual return of a fund, and then ask them questions about the 7th year annual return. Basically, guess the 7th year's annual return. But it's not a question about guessing, because one of the problems of these belief elicitation questions is that if you ask people about guessing, then there may already be some biases when they are giving you the answer. So we are concealing our intention that we're trying to assess their beliefs. So how we do it? We do it following 3 steps. The first step, we elicit the range of their belief. What do they think is the minimum possible, and what do they think is the maximum possible return? And next, we elicit their median belief using 3 binary lottery questions. And then we elicit their quartile beliefs. And then we can also use the interquartile range and the whole range to understand their belief about the risk. There's some theory behind this, but I won't bother you with that. But basically, the idea is that if you think about the all possible returns as the complete state space, we're looking for a point, this lowercase a point in this complete state space that divides the space into 2 equally likely subspaces. So how we do that? We first elicit the range. What do you think is the maximum, the minimum? Let's say they answer this by saying the minimum is 10%, maximum is 30%. And next is a question that asks them to make choice between 2 lotteries. I want to win, let's say, 5 euros if the true return is between 10 and 20. Or I want to win 5 euros if the true return is between 20 and 30. They make choices 3 times to get 1 estimation of their median belief. So here's what we found. We found that people believe that funds with ESG are going to have better performance, better return performance, both in the short run and long run. And they're also resilient when updating beliefs when given negative information. And we also asked people to answer the survey question, like what was done in previous literature, and then we found inconsistency in their answers to the unincentivized simple Likert scale survey question compared with how they answer our belief elicitation method. So this is a graph showing you all the people who said in the Likert scale question, I believe that with ESG, the financial return will be lower, but here, from what we understand from our new method, is that they actually believe that the financial return will be higher with ESG. I guess I don't have much time to go over a lot of the details, but then another thing is that they also believe that funds with high ESG has lower risk, which confirms with previous literature. And the second component we looked at was ambiguity preferences. I don't have much time to go over the details, but ambiguity is actually a situation with uncertainty, and you don't know about the underlying probability distributions, which is pretty much like what the situation is like for retail investors in the market. And people may invest in high ESG if they think that high ESG can resolve some of the ambiguity. Or to some extent, you can understand that as saying that investors believe that higher ESG score gives them some more information, and that lowers the amount of uncertainty they're facing in their investment decision. And they believe that there is some connection between ESG scores and financial performance. And we do find, I don't have time to go over the methodologies, so these are some fun games to play, and we can understand how much ambiguity people perceive in when they're investing with ESG versus without ESG. So we don't find any significant difference in their contextless ambiguity attitudes. If it's not about investment, we have no difference in their ambiguity attitudes between our treatments. But if we compare the ESG treatment versus the non-ESG treatment, when we tell them this is eliciting the ambiguity attitudes with their investment returns, we find that people perceive significantly less ambiguity when there is high ESG. And additionally, we also try to understand how much they're willing to trade off between financial returns with ESG, and we do find that they're willing to sacrifice some financial returns to go for greener products, but then the problem is that the amount of greenness in the product does not matter that much, as long as it's green. Okay, in conclusion, simply asking about pension beneficiaries' sustainability preference probably won't work, and pension funds can also try to implement different ways to assess their clients' sustainability preferences, but from our findings, we do find that high ESG labels will already influence people's understanding about financial performances of funds. For instance, they expect higher returns, lower risk, and they're more resilient to negative information, and they perceive lower ambiguity when they know that they're investing in a high ESG product. And this is probably potentially important for theoretical foundation of socially responsible investment, and we also create these measures that are potentially portable to different contexts. Now we only do this with students in the lab and also index fund investors that we're collaborating with the index fund. But of course, if any pension fund or any people sitting here are, can offer us opportunity to do this with a pension fund, that will be really appreciated. And thank you so much. That is my presentation.
Okay, thank you very much. Okay, so I'd now like to pass on to Tabea.
Thank you very much also for the opportunity to give this presentation here. We're now switching topics to something else that is not only going on in Germany, but also in other countries around the world at the moment, and that is the development of digital tools or platforms that might help individuals get an overview about their potential future pension outcomes. And what we're doing in this paper is we're investigating or trying to understand how such digital pension overviews might help people plan and save for their retirement. This is joint work with my colleagues Andreas Hacketal, Johannes Kasinger, and Christine Laudenbach. They're all from SAFE and Frankfurt Goethe University. So the background of this talk is that in recent years we have seen a shift in the responsibility for retirement income to the individual level, and that also increases the responsibility for individuals to plan and think ahead for their retirement individually. At the same time, we've seen a shift to the multi-pillar pension systems, so people not only can get a pension income from the state pillar, but also accumulate potential claims in occupational pension systems, potentially multiple occupational pension systems if they switch employers over their lifetime, and also additionally in potentially multiple private pension systems. And so to actually get an overview over the future pension claims becomes an increasingly complex task, because people have to accumulate the potential pension income that they will get from these different pension products and across the different pension pillars. And so only assessing the status quo, which is the first step if you want to think about your future pension, can be quite a complex task, because these products differ in the type of information that is provided to individuals. They differ in the risks, in the returns, in the potential features like survivors' pensions that are associated with specific pensions but not others. And so it's really very complicated to get an overview over the potential future claims that you have across these different pillars. And so digitalization and aggregating these future claims into one tool actually might help individuals get an overview of the types of claims that they have accumulated. And so the graph that I'm showing on the right is for the German pension system. We had a big pension reform in 2001. And a result of this was that the share of individuals that only has a claim to the public pension pillar declined from more than 70% in the beginning of the 2000s to around 40% that we have nowadays. So that is just to show you that this trend in individuals that have claims from multiple pillar is something that has driven specifically the German pension system, but also many other pension systems around the world in the last decades. So there have been recent policy initiatives that have introduced these types of pension platforms, especially in Europe. So there are platforms available already in Denmark, in Sweden, in Norway, and in the Netherlands. However, most of them only focus on the state plus the occupational pension system. Very few of these systems actually allow also the integration of private pension claims. Now the UK has a pension dashboard in preparation. I don't know if it's actually published, so maybe some of you might know more about this. In Germany in the past years, we've also worked on the development of such a tool that will actually indeed incorporate all three pillars of the pension system, and it is expected to be launched this summer in a first pilot phase. Now, so far there is very little evidence on the effects that these platforms have on pension planning and saving activities of individuals that have the opportunity to work with these platforms. And so the research question that we are trying to answer in this paper is whether this simplified pension information that is available in these platforms and can help individuals plan and save for their retirement. And we're specifically interested in heterogeneity between individuals with high and low financial literacy, because ideally you would want specifically individuals with ex-ante low financial literacy to profit from information that is provided in these platforms in order to help them get a better overview over their future pension claims and improve pension saving behavior. So what do we do in this work? The goal is, as I said, to test causally the introduction of such a pension platform on saving decisions. And the treatment is a pension tool that we as researchers developed jointly with a small fintech company and in cooperation with two large German banks that cooperated in this initiative. It was a pilot project. This tool is not in this form, not available anymore at the moment, but we are developing further tools that also have other features in addition and that we will also use for future field experiments. In a nutshell, what we did is we developed a digital application that provides the participants in our field experiment with a possibility to upload all their pension documents by taking a picture with their phone or by sending us the documents in paper. And we had a huge group of student research assistants over 5 months that actually sat in a small room at Goethe University and put all these numbers manually into the back end of our tool. So this was a completely manual task. On average, it took us about half an hour to compile one of these overviews. And so it was a huge effort that went into the calculation of this tool. What the German government is at the moment doing is they're digitalizing this whole process in order to make it feasible to roll it out across the whole nation, because if they would stick with a manual procedure, I don't think that we could do it in any reasonable amount of time. But at that point in time, that was the way to do it, because we wanted basically to prove that it can be done, because there was huge opposition also in Germany against providing this type of overview, because especially people from the industry were very concerned and opposed, and they basically told us it cannot be done. And so basically one thing that we wanted to show what actually it can be done. The second, more academic point is that we wanted to see whether it actually helped and what kind of an effect such an overview could give people. And so the approach that we took, that we really did a randomized field experiment. So in our field experiment, we have access to bank clients of these two large cooperating banks. And they posted the invitation to the participation in this field study on the logout pages of their online web pages. And so when people got this invitation, they could click on the link, and then they were forwarded to a study by Goethe University, and then they filled in an online survey, and then the control group only filled in the online survey, and the treatment group was forwarded to the participation in the pension dashboard. And the cooperation with these two banks actually gave us the opportunity to match the survey and the participation data with data from their accounts, so we can actually see bank account activities pre and post intervention, both for the treatment and the control group, in order to see whether this type of treatment actually had an impact on people's saving activities and portfolio choices. And so the main result that we find is that the access to the pension dashboard decreases the individual's self-reported uncertainty about the future retirement income. It also increases saving activities, and the saving activities are particularly increased among those with ex-ante lower financial literacy. Now, let me take the last 5 to 6 minutes to actually give you some details on the design. So in total, we had 4 different groups in our data set. The first one is the treatment group. For the treatment group, we have information from up to 3 surveys. So the first one is pre-intervention. The second one is right after they saw the outcome of the pension dashboard, and the third survey is about 1 year after the first survey. Plus, then we have bank administrative data for 12 months before the intervention started and for up to 8 months after the intervention. Then we have the assigned to treatment group, and that's actually a rather large group because, as you can imagine, uploading of the document provided a major hurdle to these individuals, because some people actually had difficulty finding the documents, had difficulty finding the right documents, and so there was a lot of back and forth also between the students in the back office if people did not provide the right documents, or they took the photo of the wrong page where there was not the relevant information, etc., etc. So this was actually quite a major hurdle. So we lost about 80% of initial clients in this stage of getting the documents into the tool. Yeah? And this was something we anticipated because we knew it would be really, really complex. However, the fact that we have some information on these individuals gives us the chance to actually analyze and take control of this problem during the analysis phase. Now, then we have the control group, which was not assigned to the treatment at any point in time. They only got this first and the third survey, and we have administrative bank data of that group. And then in addition to that, we have a so-called zero-touch group, which is basically just a random sample of bank clients that were given to us by the banks, so that we can actually compare which type of clients selected into participation in the first place. And this also gives us a lot of power to control for any type of time trends that are going on during the intervention phase. So overall, we have a lot of data, and this is a really big opportunity to do this type of study with such a rich data set. Then what did people see that got the pension dashboard? So basically, it boiled down to a one-page overview. where we had personalized information based on all the documents that the individuals uploaded. It included information on the public, the private, and the occupational pension system. We presented gross and net tax information. This net calculation actually cost me headaches, but we did it. And then we presented guaranteed pensions plus a potential additional income from profit participation, interest payments, etc. We didn't really present much about potential risks in these pension outcomes because we wanted to keep it simple in this type of field experiment. We are currently working on a much more advanced type of study where we can also give people an idea of the potential risks of these pension incomes. And we only compiled, that's important to understand for the treatment, we did not add any information. We only compiled existing information for these individuals. So there was nothing we did that was not available to these people beforehand. And then, just to give you an idea, the participants in this experiment ultimately uploaded around 4.5 products. So the participants had, on average, rather complex pension portfolios already. They had a projected retirement income that is a nominal value of 3,200 euros. So, but that's also in nominal terms, that's a rather high number of expected retirement income. And I already told you that the effort for compiling one of these dashboards was actually rather high. So here we said it took on average about 24 minutes to do one of them. Overall, we calculated 1,060 of these dashboards. So in the end, I think we compiled rather large number, even though in terms of the number of people who were initially interested in the field study, there was a huge dropout. Now, the important outcome variables that we looked at were the subjective pension overview. So that was a subjective assessment of the statement, I have a good overview over my accumulated pension entitlements today, from fully disagree to fully agree. And these were measured in the first survey and in the third survey. And so we can basically do a comparison in the change of this personal pension overview between the treatment and control group. And then we're looking at administrative outcomes, and that is we're looking at the saving account balances in the 12 months before the intervention and up to 8 months after the intervention, and we're looking at overall wealth, which is the sum of the amount of money they have on the saving accounts, the transfer account, and portfolio balances from the administrative bank records. So then we're also measuring financial literacy. I'm not going to go into the details here because I want to take the last 2 minutes to actually show you our results. So this is basically, these are the results from the change in the subjective pension overview. What you can see is the 3 pillars on the left are the treatment group, the 3 pillars on the right are the control group, and we split them into groups that say that they have a worse pension overview after the treatment, or at the second point in the measurement, they have more or less the same assessment of the subjective pension overview or have a better assessment of the subjective overview. And you can see that for the control group, the fractions are basically 1/3, 1/3, 1/3 more or less. And for the treatment group, we see a substantial increase in the number of people that say they have a rather good overview over their accumulated pensions. So this is basically just checking whether people found this information helpful. Now, and we looked at the saving balances and the wealth changes. So this is for 3 groups. You can see the treatment group, the control group, and the zero-touch group over the whole number of months for which we have the data available. You can see the thin dashed line. That's basically the beginning and the end of our intervention period. And this is the raw data. So what I'm going to do next is just jump to the regression results. And what you can see here is that if we look at the overall effects, and these are basically the effects estimated from our regression models. These are basically different dynamic difference in difference models, including fixed effects. So basically with this fixed effects model, we are taking care of the selection that is going on in the whole experiment based on individual characteristics. And what you can see is the gray bar, where you see an increase in the saving balances of these individuals that actually only turns out to be significant in one of the periods post-treatment. However, if we split the sample into those with high and low financial literacy, you can see that there is a lot of an increase in the saving balances specifically for individuals with ex-ante low financial literacy, and even a decrease in the saving balances of individuals with high financial literacy. How that decrease is not significant in any of our specifications. Now, I'm out of time, so let me just very briefly show you this is very similar if we look at active savers. This is very similar when we look at total wealth. We also estimated intention to treat effects and the treatment effect on the treated. The pattern is always the same. However, here the effect is watered down by the fact that we only have 14.5% of compliers in our experiment. So the weak effects in the ITT were expected. And if some of you want to have a methodological discussion, I actually believe in the fixed effect estimations much more than I do in the ITT estimation, but that's a methodological side note. Anyway, so let me conclude. So overall, we find that access to such digital pension dashboards have the potential to decrease the uncertainty about future retirement income and potentially increase saving and wealth of these individuals. In our experiment, we find that the effects are particularly strong for individuals with ex-ante low financial literacy. However, a caveat is that we have a self-selection of participants with, on average, relatively high financial literacy, complex pension portfolios already before participation, high wealth, and that is a group that is already has a very high propensity to plan by themselves. And so the big challenge is how we can reach individuals with ex-ante low financial literacy and a low propensity to plan, even with these tools from which they could potentially benefit a lot. And so, as a conclusion, providing better pension information has the potential to mitigate retirement planning disparities, but much more research is necessary in order to understand how to reach and activate these hard-to-reach groups. Thank you very much for your attention.
Thank you very much. So now our third speaker, Olivia.
Thank you very much. Two very fascinating talks. I can't wait for the questions and answers. So my discussion, if you'll permit me the zapper, thank you, is around some research we did regarding how the COVID pandemic changed the way that Americans managed their debt and dealt with retirement readiness. And this work is co-authored with Anna Maria Luzardi and Andrea Hassler. And it continues a series of studies that we've been doing on the extent and the rising problem that older people face around debt. So our motivation was very simple. Increasingly, older people, and younger as well, have access to all kinds of debt and credit that they didn't used to have access to in the past. Many of you, maybe yourselves, have apps on your phone where you can pay bills, you can borrow money, you can invest in stock portfolios. My students, I'm sure, have way more than I do. So credit cards are far easier to get. Complicated mortgages to buy homes have become increasingly available. I mean, the 2008-9 global financial crisis in part was caused by people having access to mortgages they really didn't understand. Student loans are an enormous issue right now in the US. People who have taken out student loans, sometimes for themselves, sometimes for their children or grandchildren, are now reaching retirement age. And it turns out that 6% of retirees have their Social Security benefits garnished or reduced by virtue of the student loan repayments that they have to make. Student loans were not that big a deal in the past. As I mentioned, online apps, and then there's all sorts of what we call non-traditional access to credit. Payday loans, so you can go down to the street corner to a payday vendor and say, I'm not going to get paid for 9 days. Can I get an advance? And they're happy to give you a cash advance for an exorbitant interest rate. Rent to own. If you don't have enough money to buy a TV, you can rent and pay a very high monthly premium, and then eventually, if you keep paying, you'll be able to own the TV. But you will have paid 2 or 3 times more than the value of the TV. So this is a whole new set of access to financial instruments that people didn't used to have, and particularly older people. Now, of course, borrowing decisions are also increasingly in people's own hands. You used to have to go down to the bank if you wanted to take out a mortgage, and they'd review your financial background and maybe ask you personal questions. Nowadays, you can get a mortgage online. The decisions themselves are very complicated. And of course, in this time of rising interest rates, it becomes exceedingly dangerous to hold debt and not repay it. In fact, failure to repay has important consequences across a whole range of different outcomes. People end up having their credit cards canceled, they have their automobiles repossessed by the lenders, default and bankruptcy becomes an issue. So this was something that we had started to think about, and were worried about whether things had gotten worse or better during the pandemic. So before COVID-19, if you can think back to those good old days, about 1 in 3 families had been described as financially fragile. This means they could not pay for an emergency expense, like having to buy new tires for their automobile or fix a hole in the roof if it was raining in. A majority of Americans, 51%, said they had never tried to plan, figure out how much to save for retirement. So obviously, if they're not planning and saving for retirement, they're probably going to end up in trouble in retirement. And we also found with the Health and Retirement Study, which started in 1992, following cohorts of people into their older ages, more and more people are reaching older ages holding debt. And in particular, mortgage debt. When my husband, who's now retired, wanted to retire, this was probably about 7 years ago, he said, I want to retire, we need to pay back our mortgage. And I said, why? We could continue, I'm going to keep working. He said, I'm from Ohio, and in Ohio, we repay our mortgage. How do you argue with that? This was the ethos of the previous generation. So nowadays, that's not true. So what we wanted to know again is, what about during the pandemic? We were fortunate to have access to this data set. It is collected in conjunction with the TIAA. This is the Teachers Insurance Annuity Association. I'm a member of this pension fund. And also GFLEC, the Anna Maria Luzardi Center out of George Washington University. And you can download the data. It's anonymized, it's available, and it's I believe it's every 3 years. and you can gather the data yourself and analyze it yourself. So the real purpose of this was to look at knowledge and understanding and financial decision making. So this was our basic data set, the PFIN index. It has a very extensive set of questions about personal finance, organized into 8 groups, topic areas: earnings, savings, consumption, investing, borrowing, insurance, and one of our favorites here, understanding risk, and also go-to information sources. In other words, if you didn't know what you might get from Social Security, where would you go online to be able to access it? So this is where we started to look at this set of information. And fortunately, because Anna Maria Luzardi and I helped design the initial financial literacy questions, we also included our big 3 questions on financial literacy. And I will give you some examples of these in a second, but just to be clear about what we're defining as financial literacy, it's the ability to understand and process economic information. These financial literacy questions, by the way, have now been included in dozens of studies around the world. The Health and Retirement Study is the US study where we focused on people age 50. We then decided, well, if the people age 50 and older are not well informed, what about the young people? Well, they're not very well informed either. What about the middle age? Not either. So there's a number of other American studies that have adopted these questions. And then perhaps some of you have participated in extending the coverage of these questions in your countries as well. So we have surveys with Germany, Italy, Netherlands, Russia, Mexico, Sri Lanka, Chile. And then the global PISA test for high school students has also included these big 3 financial literacy questions. So in case some of you don't know what these questions are, this is a test. And we will tell you what our questions are. So the first one is the interest rate question. It says, let's say you have $100 or euros or whatever in a saving account, paying 2% interest a year. How much would you have in the account at the end of 5 years? Now, we didn't expect people to start compounding on their telephones or what have you, so we gave them some choices. Less than $102, after 5 years, remember, equal to 102, or more than 102. And you could also answer don't know or refuse. What's the right answer, class? No, what do you think is the right answer? Anybody argue with more than 102? You are right. No extra coffee needed here. Second question, we're getting more difficult. Inflation. Imagine the interest rate on your savings account was 1% a year, and inflation was 2%. I wish it was 2% now, but this is the question. After 1 year with the money in this account, would you be able to buy more than today, equal today, or less than today? What's the right answer? Thank you, and you're right. Perfect. You're really doing well here. Now, the last question is the most difficult. It's the most difficult because it asks about risk, and we've heard earlier how much trouble people have understanding risk. But it's also the easiest question because it's true or false. So you have a 50-50 chance of getting it right. So I'll read it. True or false, buying a single company stock usually provides a safer return than a stock mutual fund. So what's the right answer? False. Absolutely right. So you guys, you win 100%. Fantastic. I'm glad that you're here in this meeting with the pension supervisors and pension managers. Okay, how much do people really know? So, before I get there, so we ask, well, I've been asked why these 3 questions. Well, first of all, they have a right answer. And that's important because a lot of answers in finance, a lot of questions could be argued. Depends on your preferences, depends on this, depends. These are simple, they're relevant, and they're brief. Second, these questions, they do measure the underlying knowledge, and if you don't know the answers to these three questions, you're probably not going to understand saving, investment, or decumulation very effectively. Third, they relate to real-world decisions that people have to make. Things like, how much shall I save? If I save 10% of my income now and the interest rate is 2%, how much will I have in 30 years or whenever I want to retire? And they capture general concepts rather than the specific understanding of this pension plan or that mutual fund. And they're few. And the reason that having few questions is a good idea is that if any of you have conducted surveys, it's expensive to ask a lot of questions, not only in money costs and incentives, but your participants get bored and they get tired. And especially if you start looking at older populations, it's compounding a problem. So that's why having few questions was also very important. So this was our first look at the results. We looked at people age 50 plus, and this is in the US. And here's the set of results. So the first column, after the first column of answers, is the correct, percent incorrect, percent don't know, and percent refuse. So with regard to the interest rate question, okay, 2/3 of the older Americans got that one right, but 1/5 got it wrong. And that's pretty staggering, right? If you don't even know that after 5 years, 2% interest is going to be more than $2 on 100. Inflation. Now this was survey questionnaire was tallied pre the most recent inflation. So still, 3/4 of people understood inflation. And what about the risk diversification question? Only half got that right. And that's really a concern if you understand that people are trying to make decisions in their defined contribution pensions and other saving as well as mortgages, for example, which are going to be charging you. However, even more interesting, 33% of the people could not answer it at all. And if you add another 10% that refused, that's a lot of folks being, shall we say, out to lunch. Only 1/3 of the people could answer all three questions correctly. And now, mind you, this is after a lifetime of financial decisions on student loans, on mortgage, on saving, on banking, credit cards. And only half, 56%, could answer the interest rate question and the inflation questions correctly. So this is a concern. And based on this, we then started to go into more detail, because how can people be so financially illiterate? Before we do a couple of other depictions, this is a percent correct by sex. The blue is the men, the pink is the women. Sorry to be so traditional. The interest rate question, typically men perform better. 75% of the men got that right, 62% of the women. 82% of the men got the inflation question right, 71% of the women, and 59% of the men and only 48% of the women got that correct. So, and this is kind of a repeated pattern, unfortunately, that we've seen in every country. Women typically score less well than men, and we can come back to why during the discussion if you wish. The good news, as I am an educator, the good news is, as you go from the left to right in this graph, the people on the far left, the shortest bar, those are high school dropouts. And they are the lowest in terms of being able to answer all three financial literacy questions. As you move to the right, they tend to do better. So that's nice. And that's the percentage calculation question. However, if you look at the interest rate question, let me make sure I've got that right. It's very far away. The percentage calculation question is, I believe, the dark green, and the interest rate question, the college kids know more, but not that much more. As I've said, we've done a number of these studies around the world. This is the percent of people within each age group for selected countries who could correctly answer questions on 3 of 4 topics. So Germany is listed on the left of the graph. You have the 15 to 34-year-olds on the far left. The middle bar, the green, is the 35 to 54, and the 55 plus is the blue bar. And I'm sorry if you're colorblind, but it's left to right. So Germany scores quite well. Canada, UK, US sort of in the middle. Hong Kong, you know, not bad. Certainly a lot better than China as a whole. And it's not surprising to me that China didn't score higher, because it's only been relatively recently that the financial markets have been opened to people to do saving and investment. But so you do see there's an enormous diversity. So in our study, going back to the COVID period, we measure who is what we call debt constrained. A debt constrained individual or household would be someone who says, yes, debt and debt payments prevent me and my partner from adequately addressing other financial priorities. So if you said strongly agree or somewhat agree, we call you debt constrained. The other categories were neither agree nor disagree, somewhat disagree, strongly disagree, and we also had some don't knows, and not so many. And then we also asked people to tell us, are they retirement ready? And this is their self-assessment. So you could disagree with what they think, but this is what they thought. Have you and your partner ever tried to figure out how much you need to save for retirement? So if you said yes, you're moving toward retirement readiness. Of those, we said, do you and your spouse or partner save for retirement on a regular basis? And if you said yes, we said you're retirement ready. I should probably have called it retirement readier, because you might not save enough, but at least you're trying. So what do we see in the data? What we learn in the data, and these are just a set of summary statistics, I'd be happy to send you the paper if you wish. About 1/3 of the people were debt constrained in 2020 and 21 during COVID. The prime age people, you may not find this surprising, the prime age people, this is age 30 to 44, they were most debt constrained. Why? Well, because they probably have children, they're probably trying to help pay for their schooling, mortgages, student loans, childcare costs. So that's a group that's really being compressed from both ends. Oops, we also find, come back, that Blacks and Hispanics, who in the US are typically less highly paid, also are more debt constrained, 35 to 45% compared to whites, about 1/5. The people with the least education are typically more debt constrained, 48% of the high school dropouts versus college, 25%. And here's something that really interested us, was that the most financially literate people were less burdened by debt, less constrained by debt, compared to the financially illiterate. 70% were less debt constrained than compared to 43. What about retirement readiness? Again, the sensible things that one might anticipate is that people across the entire group and across both years, fewer people who were debt constrained had planned for retirement versus non-debt constrained. So about 26 to 31% of the debt constrained did plan for retirement, whereas close to half of the non-debt constrained planned for retirement. If you only look at non-retirees, so these are people who still have some runway ahead of them to do something about retirement, fewer than 41 to 43% of debt constrained could save for retirement versus 3/4 of the non-debt constrained. So it's kind of a common pattern. The people who are debt constrained also don't do much saving and planning for retirement. What else might people do post-pandemic? Well, one of the things that people highlighted that they would very much like to do is become more financially literate. The one thing that the pandemic did highlight to them is that they needed to boost their financial literacy, especially with regard to saving for retirement. And the debt-constrained people during the pandemic were those who most wanted to access additional financial education and financial literacy. So that's the good news. The question now will be, can they execute? Can they find the right sources? Can they invest as they wish? So a couple conclusions. The vulnerable groups that we've identified did struggle the most with debt burdens during the pandemic. Interestingly, the pandemic did not increase people's debt burdens. And one of the major reasons was the US government spent a ton of money on stimulus funding, longer and more generous unemployment benefits, benefits for families with children. However, that money has now run out. And so what we're thinking about doing is following up after the money has run out this year or beginning of next year to see if those folks are in fact more burdened. We also showed that financial knowledge is essential for managing debt and building retirement security. And there is something of a sea change in people's desire and demand for financial education. So in closing, I would say the financial literacy is really an essential skill for the 21st century for all of us. And by way of conclusion, I thank you. I also mentioned to you, this is a propaganda slide, all of our books are now available, open access, free on our website. There's also some pamphlets outside in case you're interested, including our newest book on pensions and sustainable investment, which just came out last week. So with that, I have just some references, and thank you very much for your kind attention.
Thank you very much, Olivia.